Stop thinking silver has one price. It doesn't anymore. Right now, this week, China is paying $16 to $18 more per ounce than US futures say. Silver is worth, not 16 cents, $16. That's a premium gap we haven't seen in years. While Comex warehouses drain registered inventory overnight, Shanghai buyers are writing checks at cash premiums that scream physical shortage. Here's the question nobody's asking. If silver is abundant, why is the world's largest physical buyer paying these kinds of premiums? Not for leverage, not for paper contracts, for metal, now. If you're holding silver, watching silver, or completely ignoring silver, this split matters. Because when physical demand overwhelms paper pricing, one of two things happens. Either futures rip higher to close the gap, or the paper market loses credibility entirely. If you're watching this now, you're early. Most people won't notice until the gap closes violently. They'll see the price jump and wonder what happened. You're going to understand the mechanics before that moment arrives. I'm not here to tell you where silver's headed. I'm here to show you two patterns that repeat in every physical squeeze, and the signals that tell you when stress is building versus when it's breaking. By the end, you'll understand why paper markets always blink last, and who pays when they do. Let's go. Before we dive in, quick ask. If you want to stay ahead of market shifts that most people miss, hit subscribe. We don't chase headlines. We watch what moves quietly before it explodes loudly. Here's what just happened. Silver ripped past $100 per ounce. Shanghai premiums exploded to levels we haven't seen since 2020. Comex registered inventory, the metal available for immediate delivery, has been draining fast, not total silver, deliverable silver. This isn't speculation driving price. This is location-specific physical demand. And here's the hidden layer most traders miss. Futures prices don't clear physical shortages. They defer them. Paper markets absorb stress, delay signals, and assume warehouses will always have metal available until they don't. This is where silver stops behaving like a chart and starts behaving like plumbing. Here's how this pattern works. Think of two connected tanks. One tank is the paper market, futures contracts, leverage, price discovery happening electronically. The other tank is physical silver, bars in vaults, coins in dealers' hands, metal that actually moves. Between these tanks sits a valve. That valve is deliverable inventory and arbitrage flows. When demand stays balanced, the valve works fine. Futures prices and physical prices stay close. Small premiums exist. Shipping costs, dealer markups, but nothing extreme. But when one side pulls hard, the valve narrows. Right now, China is pulling. Industrial demand for solar panels, EVs, electronics, strategic stockpiling, energy transition build-outs. They need metal now, not promises of metal in 3 months. The paper market doesn't care. It's still pricing silver based on leverage, hedging activity, and historical norms. It assumes the valve stays open. It assumes warehouses always deliver. That assumption works until physical delivery pressure forces repricing. And repricing never happens early. It always happens late and fast. We've seen this before. 2011, 2020, different triggers, same mechanics. Paper markets anchor on old assumptions while physical buyers bid up real metal. The gap widens, stress builds, then snap. Every metal crisis looks calm, right before the anchor snaps. Here's why this pattern repeats. Futures markets are built to absorb short-term stress. They're designed for hedging and speculation, not for clearing massive physical imbalances. When real metal demand overwhelms contract settlement, the system has two options: deliver metal or settle in cash. Cash settlement protects the exchange, but it destroys price credibility. And when credibility cracks, physical premiums don't just rise, they explode. Let's go deeper. Comex warehouses hold two types of silver: registered and eligible. Registered silver is available for delivery against futures contracts. Eligible silver is just sitting there, owned by someone, stored at the exchange, but not available for immediate contract settlement. Most people watch total inventory. That's the wrong number. What matters is registered inventory. That's the valve. When registered silver drains, the valve narrows. Delivery capacity shrinks. Even if eligible inventory sits at high levels, it doesn't help unless owners convert it to registered, and owners don't convert unless they're paid to do so. Right now, registered inventory is dropping, not slowly, fast. Here's the dangerous part. Warehouses aren't designed to run dry. They're designed to be buffers, shock absorbers. When they flip from buffers to choke points, the entire pricing mechanism destabilizes. Think about that. A futures exchange relies on the assumption that physical delivery is always possible. It doesn't need to happen often. Most contracts settle financially. But the option must exist. When registered inventory gets tight, that assumption wobbles. Suddenly, delivery becomes uncertain. Lead times extend. Premiums spike. And the futures market has a choice: reprice higher to pull metal back in or change the rules. Rule changes have happened before. Cash settlement mandates, delivery restrictions, position limits tightened overnight. None of those moves calm physical buyers. They accelerate the bifurcation. The danger isn't running out of silver. It's running out of deliverable silver. Here's what you need to sit with. The real question isn't, will silver go higher? It's, what breaks if this gap widens? Because somebody's holding stress right now. Bullion banks managing short positions. Industrial users who need metal in 2 weeks, not 2 months. Dealers trying to source inventory for retail buyers. And futures exchanges trying to maintain credibility while registered inventory drains. One of these groups blinks first. When they do, the gap doesn't close gently. Let's talk scenarios. I'm not predicting which path we take. I'm showing you what signals match which outcomes. Your job is to watch, interpret, and stay flexible. First scenario, the gap narrows via higher futures prices. This is the orderly outcome. Futures rip higher, physical premiums compress back to normal, and the valve reopens. Arbitrage flows kick in. Metal moves from low premium regions to high premium regions. Stress dissipates. Signal to watch. Futures prices playing catch up fast. Shanghai premiums dropping from $18 to $8, then $4. Registered inventory stabilizing or ticking higher. Who benefits? Physical holders, anyone long futures, dealers sitting on inventory. Who feels pain? Late shorts. Industrial buyers who waited too long to lock in supply. Second scenario, the gap persists and we get regional bifurcation. This is the weird middle case. Futures stay suppressed, physical premiums stay elevated, and 2 silver prices exist simultaneously. Regional markets split. China pays one price, the US pays another, and arbitrage can't fully close the gap due to logistics, tariffs, or strategic restrictions. Signal to watch. Persistent Shanghai premiums above $10 for weeks. Delivery delays and backwardation creeping into futures curves. Lease rates climbing. Who benefits? Physical holders in tight regions. Dealers with supply lines into premium markets. Who feels pain? Paper-only traders, industrial users in high premium zones. Third scenario, delivery shock and disorderly repricing. This is the chaotic path. Registered inventory drops to critical levels. Exchange implements emergency measures. Cash settlement rumors circulate. Physical premiums explode even higher. Confidence in paper pricing collapses. Signal to watch. Registered inventory below critical thresholds. Exchange rule changes announced suddenly. Dealer premiums spiking everywhere, not just Asia. Lease rates going vertical. Who benefits? Anyone holding physical, positioned early. Who feels pain? Everyone scrambling late. Leveraged shorts. Anyone trusting paper settlement. Not advice. Pattern recognition. Could reverse tomorrow. Your job is to understand structure, not predict timing. Here's what I'm watching. Not telling you to trade on these, showing you how to interpret them. First, daily Comex registered inventory changes. Normal behavior. Registered inventory fluctuates day to day, but trends stable over weeks. Stress behavior, persistent downward trend, large single-day withdrawals, registered falling, while eligible stays flat. What it means? Tightening delivery capacity, valve narrowing. Second, Shanghai silver premium, spread versus Comex spot. Normal behavior, premiums in the $2 to $4 range, reflecting shipping and local demand. Stress behavior, Premiums above $10 sustained for multiple weeks. What it means? Physical demand in China is overwhelming local supply. Arbitrage isn't closing the gap fast enough. Third, delivery notices and exchange for physical activity. Normal behavior. Delivery notices stay low. Most contracts roll or settle financially. Stress behavior. Delivery notices spike. EFP activity surges as traders swap paper for metal. What it means? Market participants want physical, not promises. Fourth, short-term silver lease rates. Normal behavior. Lease rates stay low and stable. Metal is easy to borrow. Stress behavior. Lease rates spike. Backwardation appears. Near-term contracts price higher than deferred contracts. What it means? Physical metal is expensive to source now. Market is paying a premium for immediacy. Fifth, dealer lead times and retail premium creep. Normal behavior. Dealers ship in 1 to 3 weeks. Premiums stay consistent. Stress behavior. Lead times extend to 4+ weeks. Premiums rise on standard products like Eagles and Maples. What it means? Retail supply chains feeling upstream tightness. Wholesale allocations getting squeezed. Here's how I'm thinking about this. If you're a trader, respect volatility. Gaps can close fast in both directions. Hedge tail risk. If you're a long-term holder, accept pullbacks. Physical demand doesn't move in straight lines. If you're watching from the sidelines, recognize this. When physical markets decouple from paper pricing, the repricing event happens faster than you expect. Here's my approach. Not a command, just transparency. I'm watching flows, not just price. I'm tracking registered inventory daily. I'm monitoring Shanghai premiums weekly. I'm noting lease rate shifts and delivery notice trends. I'm not assuming the gap closes smoothly. I'm not assuming it widens indefinitely. I'm staying flexible and watching signals. Could reverse, could accelerate. Can't know timing, only structure. If you're watching flows instead of headlines, you're already in the small group that survives these shifts. Most people react to price moves. You're learning to read the stress before the move happens. That's the edge. Drop a comment. Where are you seeing premiums or shortages right now? Physical dealers, retail coins, industrial supply chains. I want to hear what you're noticing on the ground. And if you've lived through a physical squeeze before, silver, gold, copper, anything, share what you learned. We build better pattern recognition together. If this helped you see what most people miss, hit subscribe. Next video, we're tracking the next pressure point that's building quietly while everyone's distracted. Final thought, markets don't warn loudly, they whisper, then move, stay sharp.